Hello everyone, this is Mr. Josa here. Before we start, this video was funded by tips from Roberto and Hawkeye, with them dedicated to Bitcoin Melbourne and getpaidinbitcoin.com.au. Now, since Bitcoin traders seem to be some of the worst for risk management I've ever seen, it's time to take a look at how not to lose it all while trading Bitcoin. Now, the biggest risks to your account balance are as follows: the Bitcoin price surges and your stop loss management, margin calls, the exchange risk and the counterparty risk associated with this, and most importantly, trader exuberance and overconfidence. I'll do these in sections and put timestamps in the description below so you can jump to each section as desired, or watch all of them if you love your money or just my accent. Price surges are relatively straightforward and are raising a lot of the risk to your initial trade opening. Learn how to use and take advantage of stop losses. But Mr. Josa, what level do we set our stops to? Well, that really depends on the market. If carefully used, you can not only use a stop loss to control your risk, but to accumulate in a position and to hold winning positions longer. Firstly, you're looking to mitigate your risk. Say the market is weekend trending, bull or bear doesn't really matter. Ideally, you've spotted a breakout of a resistance level. In this case, you'll want to place a stop loss below your position of 1 to 3% instead in your hands. This is a stop loss at the most basic level. But if you have a favorable position and you wish to step out and not really spend much more time babysitting it, the ideal when trading is to make your trade zero risk and break even the trade as soon as possible. It's an important psychological level that will take a good part of the mental strain away from a trade. For example, let's use Bitfinex. Let's say you opened a long position trade on spot by allowing the market to fill your bid order. This means you paid approximately 0.1% fee. To break even on a trade, you must be at least 0.2% ahead on the trade from the price you opened, if you sell the long position by placing on the ask side, as to be paying the fee twice. However, in this case, you're going to be using an exchange stop loss, so it will be a 0.2% fee when you sell. Since these percentages and prices will be different, let's just use the higher number for the sake of simplicity. This will be the second position of your stop loss. Now the trade is trending, much like that $410 to $470 run-up we've recently had. It might be several days or even weeks to completion for this trend, but I promise you, you will need to sleep at some point or another. The last type of stop loss we will use is marked using support levels. As we can see here, the market trended upwards with no significant retracement before the top. This allowed me to easily target support areas to place my stop loss positions. The theory doesn't much change when it's a choppy rise either. After each blow off, there will be an area where we can see it's found itself temporary oversold support. This is where you see traders so-called buying every dip. You can use this as stop loss points for your long position so that new lows from that point would kick you out of your long in a profit. There is an obvious and major issue with this strategy. It's very predictable. Assuming everyone uses this same method of placement, an ambitious whale may market sell through this with large bids directly below so that your stop loss will fill their bids. Your experience will vary on this. Try to look back at historical price support or try to change your stop loss at round number support. A look at the order book is very revealing on where the volumetric support is, but be wary of hidden orders. Paid premium support so that your trade is not visible in the order book. The common alternative is a standard exchange trailing stop. Depending on your exchange, this will look something along the lines of the following. Now, assuming the price makes a new high, it will set your stop loss automatically to this new high, minus the price you entered here. So at $500, this would be $490 with a $10 trailing stop. Now you don't see these used very often, as a lot of people have no idea how to use them. You set them too small and people get chopped out in the smallest retrace. If you're too wide, then you'll miss the top by a country mile. It's best used with supporting analysis regarding trend volatility, or when you have a nice breakout but on very thin volume proportionally. These are the most likely to heavily retrace. Personally, I use my own self-coded indicator set to find my stop loss, but this isn't available to the public yet, so it won't be shown. Maybe another video, but for now my positions are all public on my Twitters. That's good and bad. Well, I digress. Now that we've talked about market movement, let's talk about how novice traders usually lose their account balance. Leverage, also known as margin. There's a gambler in all of us. It's a human experience that looks for an opportunity, and it sure is difficult to resist that siren call that whispers sweet nothings of big profits in our ears. I'm looking at you, high leverage traders. Levity aside, margin has several important functions in trading. It allows for the ability to take out a short-term loan for the purposes of a long or short position, using your account balance as collateral, trading using a larger balance while mitigating the counterparty risk of leaving all of your bitcoins on one exchange, and mostly in the Bitcoin space, using return swaps to earn interest on an invested or long-term position. Let's say you open a short position, that is taking a loan to sell Bitcoin and hoping the price drops so you can buy them back cheaper and pocket that delta. But what happens if you go full FOMO, open a position using all the collateral in your account, and a position goes over your head? The margin call in this type of position can be calculated using the following equation. That is, the price that you went crazy, minus fees, times the initial margin requirement, over the maintenance margin. For Bitcoin, this would be price times 0.7 over 0.85. The initial margin requirement is how much leverage the site will allow you. The maintenance margin is what level the position will be liquidated at, using a margin call, unless you have extra collateral added. Be aware that this equation does not account for fees, but these are not a constant. Return swap current rates are available on the website under the Return Swap tab. So you see, a margin long differs from a spot long in this way. In layman's terms, you buy 10 BTC on spot, you will always own those 10 BTC no matter what the price drops to. But buying them on margin will hold you to the rules of the contract. You need to carefully manage your upside reward versus the downside risk, also known as the risk-reward ratio. Now, hopefully you don't lose your head and you hold the position longer down to the margin call. But Bitcoin is littered with the bodies of the traders that did. In fact, this is so common that the regulars of Bitcoin have said you're not a trader until you've lost your first trading account. But do you really want to be that guy? Those added to the list. So let's hope you use the margin function responsibly, not as a novel method to spin your account balance on the tax-deductible roulette wheel. This one is pretty unique to cryptocurrency, but worth accounting for with legacy markets. How many cryptocurrency exchanges can you name that have closed down from lack of engagement, seized by government officials, hacked, illiquid, or just plain scumbag owners who decided that your money is better in their hands? Well, I bet you're running out of fingers to count on. So, a whole microeconomy has popped up with various types of vaults for your bitcoins as opposed to the Bitcoin Core client. The alternative is just keeping everything on an exchange, but you can see why that is foolhardy. Making a paper wallet on a clean computer, then formatting it, is a very secure cold wallet. An encrypted wallet for several Bitcoin backups for the wallet DAT files on external storage will cover your quote-unquote bank away from the exchange. There's also companies which will provide alternatives that you can pay for to secure your Bitcoins, but I don't use these, so I won't shill them. As opposed to the counterparty risk, as mentioned in the margin section, one method for you and my personal favourite is to use the margin feature to only hold a fraction of your funding reserve on the exchange side. For example, let's say that you use 3x leverage on Bitfinex. The stop loss for a trade can be fairly liberal with that low margin, and the margin call's really far off, so it does allow you to trade approximately 33% of your trading capital while remaining 66% is in cold storage, but retaining the same purchasing power. The same could be said about the legacy banking system. You store your value in money which is then deposited in the bank. They will give you interest on this for allowing them to use the funds for their own credit purposes, and you can use their network to avoid having to carry around thousands of dollars. However, there is a counterparty risk to this. The bank could default, there could be bail-ins by the government, inflation of the currency, and so on and so forth. Extreme examples, sure, but you can see why it does pay to manage the risk of your value, instead of putting all your eggs in one basket. Diversified investing doesn't have to start at the stock exchange. And finally, a trader buys $10,000 of Bitcoin in August 2013. The price increases 1,200% in the next 4 months. The trader has now made their yearly salary or even several times this. Psychologically, you are now compromised. Chances are that you will be cheering on the price with every new high and screaming to buy every single dip, and this is how people lost millions at the year-long bear trend to less than $200. It really says a lot when the suicide hotline is pinned to the top of a leading Bitcoin forum. As of making this video, I've been on a short-term winning streak, but I've also attempted to short the price back to $500 in November 2015. Nobody is infallible. I certainly am not, and this is why I don't use double-digit leverage. Like I said before, the more experienced traders will talk about a completely burned account like it's a regular thing. Bitcoin trading is not a game. It's real money, and there are some very smart people looking to take your money and add it to their own. Then you decide to turn it up a notch and use bots to move the order book and seemingly try to kill every single position you take. Remember that the trend is your friend, so unless you are highly skilled at managing your risk, do not attempt to scalp or take positions based on less than 1 hour candles. But the full quote goes, "The trend is your friend until the end when it bends. Master your stop losses and most of your trades will at least break even. Killing losers quickly while allowing gaining trends to continue can allow you to still make money, even if your trading positions are 40% correct at best. After that, with good technical, fundamental and sentimental analysis, if your winning trades ratio is higher, well, that's just more profit for you. Or go all in on margin with your whole account, but don't cry when that transfer of wealth away from you occurs." Thank you very much for watching, and cheers.